Time now for today's Market Movers with easy-to-follow futures and options trades from CME Group.
Welcome to Market Movers. I'm Jim Urio, and we are fast approaching the heart of earnings season. Now, between April 23rd and 26th, we get Google, Amazon, Microsoft, Facebook. We're going to be looking at using weekly NASDAQ options to either hedge risk or create additional exposure. Joining me is Chief Investment Officer at Kingsview Asset Management, Scott Martin.
Hi, Jim.
Okay, earnings have been good so far.
Yeah.
Bank earnings have been good. Are these earnings going to be blockbusters? Is this continue, and why are they going to be good?
I think they're going to be blockbuster. I'll take that word from you if I may. Now, the real question, though, Jim, is how does the market react to it? You mentioned the financials earnings. Great pre-market reaction to some of those financial earnings. Bad open market reaction once the market opened and started fully trading them. So I think this could be one of those situations where it's a sell the news type of situation because the market seems to want to do it.
Expecting too much.
That's right.
Okay, interesting. Now, we've had 2 months of a corrective phase. Is it over, in your opinion?
I wouldn't quite underline it that it's over, like a friend of mine once said, i.e. you. But I will tell you this, there has been some very positive action that I believe is constructive if you're looking to take a bullish position here. But as we know before, Jim, the market tends to say step its way up and
then take an elevator down.
You're right.
Yes. Now, before we dive into our trade discussion, I'd like to point out that as with all market movers, it's important to view these trades as examples that allow you to see different ways to use futures and options products to either manage risk or create additional trade opportunities, not as recommendations or advice. Prices and movements will vary in the markets. Underlying right now in the June NASDAQ was 6860, Scott.
Yes. So we talked about the market walking its way up the stairs to higher levels, which we've seen in the last couple weeks, which is great. And then, of course, the elevator down it may take, or it just jumps out the window. So in that case, Jim, looking at the scenario today in the landscape, I was just looking for value here. I was looking for things, Jim, that I believed were relatively cheaply priced to take advantage of maybe what was some overt bullishness out there. So specifically, Jim, the week 1 May 6600 6550 put spread in the NQs for 7 ticks expires on May 4th. The underlying is about 6860 on this trade. It risks 140 to make a potential 860. So I like the risk reward there. Talking about levels, why did I pick those two, my friend? If you look at that nice bounce the NQs have had in the last several weeks, all we need to start, say, filling out that put spread is a 50% retracement of that big move, my friend. I think it can happen. And maybe one of those scenarios, if I may say, I know you're dying to speak, where if it goes in your favor again because of that favorable risk reward, you can take some off as always and just realize some profit.
And I don't, this direction is wrong for me because, by the way, I'm the guy who said I believe the correction is over underline. It's the wrong direction for me. I do like what you said, the risk reward, because we said before, like this trade is 260 ticks away from where we're currently now. My trade is only going to be 90 ticks above, and it's only 2.5 times more expensive. However, as you said, we will tend to grind up at times, and when we go lower fast. So I'm looking at buying the week 1 May, the same expiration as yours, the 6950 7,000 call spread for 18 ticks. Now this expires May 4th as well. Underlying is 6860. It risks $360 to make a potential 640. Thoughts?
Wrong direction, but decent expression in the sense of a risk-reward possibility there with respect to, Jim, the likeliness of it filling out. Obviously, mine has a lot more reward because of the fact it's so far away. Now, here's the thing about the market volatility or lack thereof of late. As volume has dried up here, I'm guessing volatility is going to come back, which probably makes either one of these a decent opportunity.
You make a good point there. Volume has been somewhat sluggish, and that concerns me a little bit. I still like the story, but I agree with that. Now tell me this, the economic data itself, is it going to continue to get better?
I believe it will. Now, the problem with that is, if it gets better and better, does that keep the Fed in play? Because that's the real bugaboo of the market. You look at the long end of the interest rate curve, my friend, not really reacting to what's going on in the short end as far as rate hikes.
That could be trouble. Thanks for joining us on Market Movers. I'm Jim Urio, where we're helping to make you a better trader.
Check out businessfirstam.com to find out where to see our entire show. And don't forget to like, follow, and share Business First AM.